video. This is part 1 of the Chapter 9 lecture series on plant assets. Let's get started. In this video, we will discuss plant assets. We will first discuss determining the cost of such assets. We will then learn about calculating and recording depreciation. And finally, we will learn about expenditures incurred during the life of these assets. There are several names for plant assets, including property, plant, and equipment, and fixed assets. You will see all of these terms throughout the chapter, so you must know and be comfortable with all of them. There are 4 characteristics of plant assets. An asset must meet all 4 of these characteristics in order to be classified as a plant asset. First, a plant asset has physical substance, meaning it is touchable or tangible. Second, a plant asset is used in the day-to-day operations of the business, meaning that it is not held for investment. Third, it is not intended for sale to customers, meaning that it is not inventory. Fourth, it is expected to provide service to the company for multiple accounting periods, meaning that it will not be used up in one accounting period. This characteristic is why we record these items as assets rather than expenses. The cost principle requires that we record plant assets at cost. An asset's cost includes all expenditures necessary to acquire the asset and make it ready for its intended use. Therefore, there will be expenditures included in the cost in addition to the asset's purchase price. There are 4 types of plant assets: land, land improvements, buildings, and equipment. The cost of land may include the asset's purchase price, any closing cost incurred including title and attorney fees, real estate agent commissions, accrued property taxes and other liens on the land assumed by the purchaser, and cost of demolishing a building on the land less any amount received from selling salvaged materials. Please note that property taxes are only included in the cost when they are accrued on the land when purchased. Once purchased, any property taxes incurred are expensed. The second plant asset is land improvements, which are structural additions to the land. Land improvements include driveways, parking lots, fences, landscaping, and underground sprinklers. The third plant asset is buildings. If a company purchases a building, the cost may include the purchase price, closing costs, commissions, and any cost incurred related to remodeling or renovating the building. If a company constructs a building, the cost may include the contract price, architect fees, permits, and excavation cost, which are costs incurred for the foundation of the building, including dirt work. The fourth type of plant asset is equipment. Costs incurred related to equipment may include the asset's purchase price, sales tax paid, freight or shipping charges, insurance during transit, and expenditures related to assembling, installing, and testing the equipment. Please note that insurance incurred after the asset is placed into service is classed to prepaid insurance, as learned in earlier chapters. Also, please note that licenses are always expensed because they are recurring expenditures that do not benefit multiple periods. Once a plant asset's cost is determined, this amount is classed to the applicable asset account. For example, if the total cost of equipment purchase is calculated to be $52,500, the asset account equipment will be debited for $52,500. Now let's talk about depreciation. Depreciation is the systematic and rational allocation of the cost of a plant asset over its estimated useful life. Depreciation relates to allocating the cost of an asset over its useful life. It does not relate to reporting the decline in an asset's value. It is the means used to expense the cost of certain plant assets. Of the 4 plant assets discussed previously, land improvements, buildings, and equipment are depreciable. The reason these assets are depreciable is because the revenue producing ability of them decline over their useful lives, meaning these assets become less useful as time passes. The usefulness of land, however, does not decline over time. A parcel of land will be just as useful in 100 years as it is today. For this reason, land is not depreciated and is instead carried at cost until it is disposed of. For example, if a company purchases a piece of land today for $20,000, it will carry that piece of land on its books at $20,000 until it disposes of it. So again, land improvements, buildings, and equipment are depreciated. Land is not. Now let's discuss what items are needed in order to calculate depreciation. There are 3 items that impact the calculation of depreciation. The first item is the asset's cost, as we calculated previously. The second is the asset's useful life, which is the estimate of the time in years that the asset will be used. The third is the asset's salvage value, which is the estimate of the asset's value at the end of its useful life. Please note that if your problems do not reference a salvage value, then it is assumed to be 0. There are several methods used to calculate depreciation. We will only learn the straight line method. Under the straight line method, if an asset is held for an entire year, then you will expense the same amount each year. The annual depreciation expense is calculated by subtracting salvage value from the asset's cost and dividing that amount by the asset's useful life. The numerator in this formula is called the asset's depreciable cost because that is the amount of the asset's cost that will actually be depreciated or expensed. If the asset is purchased or sold during the year, you must calculate the amount of depreciation for the portion of the year the asset was held. You simply take the annual depreciation expense calculated previously and multiply that amount by the fraction of the year that the asset was held. For example, if the asset was purchased on September the 1st, then the asset was held for 4 months. You would calculate the annual depreciation amount and multiply it by 4/12 to calculate the partial year depreciation. We learned the depreciation entry in an earlier chapter. Remember, this entry is an adjusting entry that we prepare at the end of the period. We debit depreciation expense and we credit accumulated depreciation dash whatever it is we are depreciating for the calculated amount. Now let's discuss how to handle expenditures incurred during an asset's life. There are 2 types of expenditures incurred during an asset's useful life. First, revenue expenditures are ordinary repairs which simply maintain the operating efficiency and life of an asset. These expenditures are normally small in amount. When this type of expenditure is incurred, you would debit an expense account such as repairs and maintenance expense. Second, capital expenditures are costs incurred to increase the operating efficiency, productive capacity, or useful life of a plant asset. These items are often called additions or improvements. They are typically large amounts. When this type of expenditure is incurred, you would debit the related asset account. These expenditures are therefore capitalized and are expensed through depreciation. Now let's look at some examples. First, replacement of worn out gears on factory machinery would maintain the operating efficiency of that machinery and therefore would be a revenue expenditure. Construction of a new wing of an office building, however, is obviously improving that office building, and therefore that expenditure would be classified as a capital expenditure. Painting the exterior of a building, again, is just maintaining that building, and so that would be a revenue expenditure. An oil change on a company truck, again, is simply maintaining that truck, and so that would be a revenue expenditure. Replacing an expensive computer chip in a computer which increases the productive capacity of the computer. Because the chip increases the productive capacity of the computer, this expenditure would be considered capital. An overhaul of a truck motor, a 1-year extension in useful life is expected. Because we're extending the useful life of the asset, this would be also classed as a capital expenditure. Painting and lettering of a used truck upon acquisition of the truck. Now, by painting and lettering this truck before we put it into use, that is preparing the asset for its intended use, and therefore that expenditure will be classified as capital. However, painting and lettering of a truck you have driven for 3 years, that is simply maintaining that truck, and that would be therefore classified as a revenue expenditure. This completes part 1 of the Chapter 9 lecture series. Now let's learn about plant asset disposals.